Let us now continue with problem 6-16. Uh, Here, web company had outstanding 7% 10-year 5 million face amount bonds payable. The bonds were originally sold to yield 6% annual interest. So the 6% yield rate here will serve as our effective interest rate. The entity used the effective interest method to amortize bond premium. On January 1, 2022, the carrying amount of the outstanding bond payable was 5,250,000. Okay, so if you will be asked how much then is the initial premium on the bond, our answer would be 250,000 since its initial carrying amount was greater than the face value by 250,000. Okay, first question here is what amount should be reported as premium on bonds payable on December 31, 2022. Definitely our answer here should not be 250,000 because the 250,000 bond premium we have mentioned earlier was as of January 1, 2022. The question here is as of December 31, 2022. Okay, is there an expectation that the premium from January 1 will be different from the premium on December 31? The answer is yes, because we are going to be amortizing the premium. Okay, and since there's been 1 year that has passed from January to December 31, then the premium will be reduced equivalent to 1 year worth of amortization. Okay. Uh, as discussed in the other videos, the for us for us to get the subsequent balance of the premium, for us to get the remaining balance of the premium or the unamortized portion of the premium, we have to determine the amount of amortization. Okay, and for us to be able to get the amortization, we will have to compare the fixed interest payment, with the effective, with the interest expense. Okay, so let's check first whether this problem pays interest annually or semi-annually. It states here uh, the bonds were originally sold to yield 6% annual interest. Okay, so the solution here will be very straightforward. First, let's compute the fixed periodic interest, which would simply be the product of the stated or nominal rate and the face amount. Here, the stated rate in the bond, the nominal rate or the coupon rate is 7%. So we will multiply the 7% with 5 million. We would get an annual interest payment of 350,000. Okay, but again, as you should understand by now, our interest expense will not simply be the 350,000 because there was a premium upon the issuance of the bond, and we have explained before that the premium is treated as more of a gain on our part, but we will have to spread out the recognition of such gain, and the periodic recognition of the premium as a gain will be charged off or offset against our interest expense. Since we have a premium, we expect our interest expense to be lower than the fixed interest payment. Okay, but to answer one question, if ever you're asked how much is the interest expense for this problem in the year 2022, all we have to do is uh, multiply 5,250,000 by the effective interest rate. And again, the effective interest rate here is 6%. And our initial carrying amount is 5,250,000. So you multiply 5,250,000 by 6%, we would get 315,000. Okay, so the fixed interest payment is 350,000, and our uh, interest expense is 315,000. Okay, uh, that means there is a difference of 35,000, and the 35,000 would be uh, the amortization on the premium. Okay, the explanation as to the reason why the interest expense is only 315, it's because there is an amortization of 35,000. Okay, but again, very straightforward. We were able to compute the interest expense simply by multiplying 5,250,000 by the effective interest rate of 6%. Okay, so if we are asked how much is the interest expense in this problem, our answer would be 315,000. Second possible question, how much is the amortization of the premium on the first year? Our answer would be 35,000. Now, knowing that the amortization of the premium is 35,000, we can already answer the first question here, which is how much is the premium to be reported on December 31, 2022. All we have to do is to deduct uh, the amortization of 35,000 from the starting or initial bond premium amounting to 250,000. So the remaining premium or the unamortized premium as of December 31, 2022 would be equal to 250,000 minus 35,000, and that will give you 215,000. So the answer there would be Charlie. And just to complete, actually that the fourth commonly asked question is the question number 2 in this problem. What is the carrying amount of the bonds payable then on December 31, 2022? Okay, so all we have to do again, if we're looking for the carrying amount, is to deduct the unamortized discount or add the unamortized premium, deduct the remaining discount or add the remaining premium. Okay, so how much is the face amount here? 5 million. How much is the remaining premium? How much is the unamortized premium as of the end of December 31, 2022? 215,000. Okay, so that means the carrying amount as of December 31, 2022 would be 5,215,000. Okay, and just to recap, interest expense is 315, amortization is 35, unamortized premium is 215, and carrying amount is 5,215,000. I'm taking this down because I want us to use this problem and compute for those same items, but using the straight line method. Okay, just for you to have a comparison on the difference in the amounts. Okay, because I believe there are those who are confused as to what to do when some of you might be confused on the straight line method and the effective interest method. Okay, the confusion perhaps would be uh, on your failure to remember as to what to do if you are using the straight line method or the uh, effective interest method. Okay, so we will demonstrate later as to what will be the answers if we will be using the uh, straight line method instead of the effective interest method. Okay, because supposedly, regardless of what kind of problem you are dealing with, you can answer the same questions under both the straight line method and the effective interest method. So you can expect that will be the case in our exam. Okay, I'll give you the same problem, and I will just use the method being used. Okay, you'll be answering the same questions, but of course, the answers will be different because in one case it will be using the straight line method, and in another it will be using the uh, effective interest method. Okay, but to further expand the illustration for problem 6-16, I want us to proceed to December 2023. I want us to go beyond the question wherein the questions were only for the year 2022. I want us to proceed to 2023. Okay, so first question we settled earlier was how much was the interest expense. Let's compute also for interest expense using the effective interest method for 2023. Okay, and again, interest expense is simply the previous carrying amount multiplied with the effective interest rate. Okay, for 2022, it was computed by multiplying 5,250,000 with 6%. Okay, we will still be using 6%, but we will no longer be using 5 million, 5 million 250, because that is not the carrying amount at the start of the year. And the carrying amount at the start of the year is 5,215,000. Okay, the balance on December 31, 2022 will be the, of course, the uh, carrying amount that we'll be using for 2023. So it will now be 6% multiplied by 5,215,000. Okay, so 5,215,000 times 0.06, that will give us 312,900. Okay, so the interest expense for 2023 in this problem would be 312,900. Okay, next would be how much then would be the amortization on the premium for this year. Again, we need two things to determine the amount of amortization. If we're using the effective interest method, we need to compare the fixed interest payment with the interest expense. We already have the interest expense, so we will just have to compare it with the fixed interest payment. And since it's a fixed interest payment class, the amount we computed for 2022, which was 350,000, would also be the same amount we will compare to the interest expense for our 2023 computation. Okay, and again, how did we get the 350,000? It was 5 million times 7%. Okay, so 350,000 compared or minus 312,900 will give you the amortization on the premium for the second year or for 2023, and that would be 37,000, 37,100. Okay. Third question: how much then would be the balance of the premium? How much then would be the balance of the premium on December 31, 2023? Okay, so you just deduct 37,100 from the previous balance as of the end of last year. How much was the remaining premium on December 31, 2022? It was 215,000. Then the additional amortization this year is 37.1. So after the second amortization, the remaining balance of the premium would be equal to 312,000, 215 minus 37.1. Okay, so the unamortized premium or the remaining premium or the amount of premium to be reported on December 31, 2023 would be 177,900. Then fourth question, how much is the uh, carrying amount? Again, you just have to start with the face value of the bond, deduct the remaining discount or add the remaining premium. In this case, we have a premium and the remaining premium is 177,900. Okay, and then add that to the 5 million, we will have the carrying amount as of the end of 2023. So that would be 5 million plus 177,900. Now we failed or we forgot to use our alternative solution. What was our alternative solution for the computation of the carrying amount? It is the previous carrying amount minus the amortization for the year. Okay, how much was the previous carrying amount? It was 5,215,000. And how much was the amortization on the premium this year? It is 37.1, and we will still arrive at 5,177,900. Okay, here, unlike in the other problems we discussed, in our alternative solution, the amortization is a deduction because we're dealing with a premium. For problems involving discount, in our alternative solution, we can get the carrying amount by starting with the previous carrying amount or the carrying amount at the start of the year plus the amortization and the discount. But here, since we are dealing with a premium, uh, the carrying amount can alternatively be computed by starting with the carrying amount at the start of the year or the previous carrying amount and minus the uh, amortization and the premium for the current year. Okay, let's try our alternative solution for year one. Again, since we are the first year, we start with the initial carrying amount of 5,250,000, and all we have to do is deduct the amortization and the premium, which was 35,000, and we will still arrive at the same carrying amount of 5,215,000. Okay, so to recap the second year, the interest expense will be 312,900. The amortization on the premium would be 37.1. The remaining or the unamortized premium as of December 31, 2023 would be 177.9, and then the carrying amount of the bond after 2 years would be 5,177,900. Now let's answer these same questions using the same problem, but this time let's use the straight line method. Can actually the straight line method would be is actually simpler. Okay. Now, under the straight line method, we are going the amortization of the discount of the premium would simply be spread out or uh, amortized equally throughout the term of the bond. Okay, so you just divide it by the number of years or months in which the bond will be outstanding. Now, there is somewhat of a difference as to the approach, class, because if the problem uses the effective interest method, the easiest thing to solve would be the interest expense, and you will need the interest expense to get the amortization. But if we are using the straight line method, the first item which we can solve would be the amortization on the premium or the discount, and we would then be using that amortization to solve for the interest expense for the year, to solve for the correct or the adjusted interest expense for the year. So uh, you will still be computing for the same things, but the path would be different, but ultimately the destination will be the same. Again, just to reiterate, under the effective interest method, normally you would be solving first for the interest expense, and you will get the interest expense to solve for the amortization on the premium or discount so that you can solve for the carrying amount of the bond. Okay, and then under the straight line method, uh, you will be able to solve first the amortization, the discount or premium, which you would then use to solve for the interest expense as you compute later on the carrying amount of the bonds payable. Okay, it's just a matter of which will come first. Uh, to some extent, you can compare this to our discussion on the allowance for doubtful accounts when we use the percentage of sales or the percentage of AR. When we use the percentage of sales, we get the doubtful accounts expense first, and then we will use that one to get the adjusted balance of your ADA. But if you use the percentage of AR, the amount that you would get would already be your adjusted ADA, and you will just use your adjusted ADA to determine your doubtful accounts expense. Okay, it's basically the same difference, class, in our discussion on the difference between percentage of sales and percentage of AR, and the use of the straight line method and the effective interest method. Okay. But again, the standards require that we are going to be using the effective interest method. Okay. But others would still use the straight line method because of its simplicity, and they will just argue that the difference will be immaterial. And that's why they will deviate from the required methodology of the standard. Okay. Now, let's now answer problem 6-16 under the premise that we are to be using the straight line method. Okay. Uh, so here under the straight line method, again, the goal is just to spread out the premium evenly throughout the term of the bond. Okay, so the term of the bond is for 10 years, and the total premium is 250,000 as what we have determined earlier. So all you have to do is to spread out the 250,000 over 10 years. So that would mean that every year you will be amortizing the premium in the amount of 25,000. And how did we get the 25,000? That's the total premium of 250,000 divided by 10 years. So every year there will be an amortization of the discount uh, amounting to amounting to 25,000. Okay, and that we are actually then able to solve the one of the four things that we've been computing. Under the effective interest method, the amortization was 35,000, but under the straight line method, for year one, it is 25,000. Okay, and then knowing that the amortization of the premium is 25, we would then be able to solve for the correct amount of interest expense. Okay, so again, you treat the amortization of the premium as a reduction to your interest expense. And under the straight line method, the basis for your interest expense would be the fixed interest payment. And that's what we have computed earlier. The fixed interest payment was 350,000. If there had been no adjust, if there would have been no adjustment to the 350,000 interest payment, then that would have been our interest expense. But since the bond was issued at a premium, there is technically a gain which we will have to recognize throughout the term of the bond, which will have an effect of reducing the interest expense. So we start with the 350,000 and we offset the amortization of the gain or the premium in the amount of 25,000. You would get uh, you would get 325,000. That is 350 minus 25. Okay. So we already have the amortization and the discount. Then we already have the interest expense. So if you're asking this problem, how much is the interest expense using the straight line method, your answer should be 325,000. How much is the amortization of the discount? It would be 25. Next, how much then would be the remaining or the unamortized premium on the bonds payable as of December 31, 2022? It would be equal to the initial 250 minus the amortization this year of 25. So the unamortized premium would be 225,000 as of December 31, 2022. Now, fourth possible question, how much is the carrying amount? Again, to solve for the carrying amount, it is simply the face value plus the unamortized unamortized premium. Okay, so this would be 5 million plus 225. We will have 5,225,000. Okay, an alternative solution, simply begin with the previous carrying amount, or in this case, the initial carrying amount of 5,250, and then deduct the amortization for the current year of 25. You will still arrive at 5,225,000. Okay, let's proceed to the second year. Okay, still straight line. And the good thing with the straight line class is that year in, year out, your amortization would be the same. Okay, if it was 25,000 last year, again, for the entire 10-year period, you will have an amortization of 25,000 per year. So for 2023, the amortization would be 25,000 also. Now, if you're using the straight line, under what circumstances will the amortization not be the same? Number one, if in the previous year it was not for a whole year, and for the second year it was for a whole year. So definitely the amortization for the first year, if the bond was not outstanding for a whole year, will not be the same as the second year, because for the second year it will be good for one whole year, and the first year will be less than 1 year. Okay, but on a per month basis, the amount of amortization would be the same. Okay. Next, interest expense. How much is the interest payment made in the second year? It was 350. And how much is the amortization on the premium this year? Also 25. So it will remain at 325,000. Okay. So year one, how much was the interest expense? Correct interest expense net of the amortization of the premium. It was 325. Year two, the same. Okay, that's the beauty of the straight line method, because it will just be the same. And that's why there are those who prefer the straight line method because of its simplicity. Next, but if you will now be computing for the remaining unamortized premium, or the remaining premium or the unamortized premium, it will not be the same as last year, because this amount is a running will have a running balance. Initially, it was 250. After 1 year, it was 225. After 2 years, it will not be 225 because we have an additional amortization of 25. It will now just be 200. Okay? Then you can expect that by next year, it will be 175. The following year, 150. Okay, it's very easy to plot the trend or the trajectory of your premium if you're using the straight line method. Okay. So if the unamortized premium by the end of the second year is 200, how much then would be the carrying amount of the bond after the second year? It will simply be the face amount of 5 million plus the unamortized premium of 200,000. Okay. Alternative solution, the previous carrying amount. How much is the previous carrying amount? How much is our carrying amount at the start of the year? It is 5,225,000, and deduct the amortization for the year, we will have 25,000. So the carrying amount would, you will still be able to arrive at the same amount, which is 5,200,000. Okay, so I hope you're able to see the difference, and I hope you're able to visualize that a problem can be solved in two ways, whether you will be using the effective interest method or the straight line method. Let's let's proceed to the 6-17. Okay, and just to give you an idea, perhaps we will have a similar problem for problem 6-16. Okay, and you will be computing for the same four items, and then you will be using the effective interest method or the uh, straight line method. Okay, so please take note of this problem. 6-17 on January 1, 2022, West Company issued 9% bonds payable with face amount of 5 million, which mature on January 1, 2032. The bonds were issued for 4,695,000 to yield 10%. This means that the bonds were issued at a discount. Interest is payable annually on December 31. The entity used the interest method. What amount should be reported as interest expense? Okay. Uh, let's still answer the same set of questions, class. First, let's solve for the interest expense. Again, to solve for the interest expense, using the uh, effective interest method, we simply multiply 4,695,000, which is the previous carrying amount, or in this case, the initial carrying amount, multiply it with the effective interest rate or the yield rate of 10%. So our interest expense would be 469,500. Again, take note, interest expense would be the easiest, the first thing we can solve out of the four commonly asked questions if you're using the effective interest method. And we will be using that interest expense to solve for the amount of amortization. But again, if you are using the straight line method, it will be easier for you to determine first the amount of amortization, and you will then use that amortization to solve for the uh, interest expense. Okay. Again, under effective interest method, interest expense first, amortization second. Under the straight line method, amortization first, interest expense second. Next, let's proceed now to the amount of amortization. Again, how do we get the amortization using the effective interest method? Compare the interest expense with the fixed periodic interest payment. How much is the periodic interest payment here? The face amount is 5 million, and then the stated rate, the nominal rate or the coupon rate is 9%. Okay. We do not have to worry about one half here, class, because the interest is payable annually. Okay, but please always watch out for problems wherein interest is payable semi-annually. Okay, here we multiply 5 million times 9%. The fixed interest payment, annual interest payment is 450,000. We compare 450,000 with 469,500. We would get a difference of uh, 19,500, and that would be the amortization on the discount. Okay. Third question: how much then would be the unamortized discount as of the end of the first year, as of the end of 2022? You start first by determining the initial discount. How much is the initial discount? The initial discount here is 305,000. And how did we get the 305,000? The face value is 5 million and the issued price is 4,695,000. It was issued at a discount of 305,000. So if the initial discount is 300, if the initial discount is 305 and then the amortization of the discount is 19,500, then the remaining discount as of the end of the first year is 285,500. Okay, and then fourth possible question, which is question number 2 for problem 6-17. How much is the carrying amount? Our first solution was simply deduct the discount or add the premium. In this case, we have a discount. Okay, in this case, we have a discount. So we will have to deduct the remaining discount. How much is the remaining discount? It's 285,500. So you have 5 million minus 285,500. You will get 4,714,500. And that is Charlie. Okay, the carrying amount of the bonds as of the end of 2022 would be 4,714,500. Next would be alternative solution. What's our alternative solution? It is start with the previous carrying amount and then just add or deduct the amortization for the year. In problem 6-16, we deducted the amortization because it was a premium. In this case, we'll be adding the amortization. How much was the previous carrying amount? It was, or in this case, the initial carrying amount, 4,695,000. Then you add the amortization, which is 19,500, you would still arrive at 4,714,500. And then let's just expand the problem, class. Let's go to year 2 also. Okay. Uh, First thing we will have to solve if you're using the effective interest method is interest expense. And how do you solve for the interest expense? Simply multiply the effective rate with the previous carrying amount. So the effective rate is 10%. And this time, instead of multiplying 10% with 4,695, we will now be multiplying it with the carrying amount at the end of last year, which is 4,714,500. So 4,714,500 times 10% will give you 471,450, and that is our interest expense for year 2. Next is how much is the amount of amortization and the discount. Again, simply to get the amortization, compare the interest expense with the fixed interest payment. And again, how much is the fixed interest payment? It was 450. So 471,450 minus 450,000 will give you an amortization of the discount in the amount of 21,045. So if the amortization of the discount for the second year is 21,450, how much then would be the remaining discount? How much then would be the unamortized discount uh, as of the second year? Okay, the balance of the discount at the end of the first year was 285,500. The amortization this year is 21,450. So the remaining discount then after 2 years would be 264,050. Okay, and with that we can already solve for the carrying amount after the second year, after the end of the second year. Okay, and that is face amount of 5 million minus the remaining discount after 2 years, which is 264,050. Okay, alternative solution, previous carrying amount. How much was the carrying amount last year? 471,500, and then just add the amortization this year, and that will give us the amortization this year is 21,450, and that would still give us 4,735,950. Okay, and then let's try straight line method also for this problem. Let's go back to year one. Again, remember under the straight line method, you will first be able to solve for the amortization of the discount. Okay, how much is the discount? As what we mentioned earlier, the initial discount is 305,000. Since the bond is good for 10 years, your annual amortization on the discount would be 305,000 divided by 10 years. You would get 30,500. And again, the good thing with the straight line method is that your amortization would be uniform throughout the term of the bond. Year one is 30,500. Next year we expect that it will also be 30,500 next year. Okay. Now we already have the amortization of the discount. Next is compute for the interest expense. Under the straight line method, the amortization of the discount will represent additional interest expense. Additional to what? In addition to what? It will be in addition to the fixed interest payment. How much is the interest payment in this problem? It's 450. Okay, based on the 9% interest. But since there is an additional interest expense arising from the amortization of the discount, the total interest expense for year one using the straight line method would be 480,500. Okay. Now, if the amortization for year one under the straight line method is 30,500, how much then would be the remaining discount? Okay, we started at 305, and then we deduct the amortization this year of 30.5. You would get 274,500. Okay, and then uh, we can already solve for the carrying amount after the first year, at the end of 2022. Again, the formula is the face amount minus the discount. The remaining discount or the unamortized discount of 274,500. Alternative solution, previous carrying amount plus the amortization of the discount. So since this is the first year, our previous carrying amount will just be our initial carrying amount of 4695, and then you add the amortization this year of 30,500, you will still get 4,725,500. Okay. Next, let's proceed to year two. How much? The first thing we should be solving would be the amortization of the discount. Again, the good thing with the straight line method is that it will be the same. Okay, it was 30,500 last year. It will be 35,000 on the second year. Now with this, we can already solve for the interest expense. And again, the good thing with the straight line method is that your interest expense will also be the same as the previous year, as long as there are no other reason to cause a difference. Okay. Next is third possible question for year two. How much is the remaining discount? Okay, after the amortization last year, the remaining discount was 274,500, and with the additional amortization this year of 30,500, the remaining would be uh, the remaining discount would be 244,000 after 2 years. After 3 years class, just deduct 3,500, so on and so forth. Next, carrying amount. Okay, it's 5 million minus the remaining discount or the unamortized discount, which in this case for the second year is 244. You will have 4,756,000. Alternative solution: previous carrying amount plus the amortization this year, since this is a discount. How much was the carrying amount last year? It's 4,725,500, and then add the amortization this year of 3,500, you would still arrive at 4,756,000. Okay. Now, I hope nobody is thinking that the figures under the straight line method and the uh, under the straight line method and the effective interest method are supposed to be the same. Okay. The amounts are expected to be different. Okay. We're just using the same problem to demonstrate the application of the two methods. Okay, and we'll end here for a moment, and the other problems will be contained in another video.